All right, today is May 21st, and Ariana is here with a question on project number 2 on what data to upload for financial statements. Okay, so what I like to do is I like to go to this document, how to obtain financial statements from the SEC. So let's bring that one up. Can you guys see my Canvas screen here?
Yes.
Okay, perfect. All right, so let's look at this document really quick because it might be helpful. So I hope it's helpful. So step 1 on this project 2 is for you guys to get your financial statements and upload them, because you're going to be running ratios with the financial statements so that you can keep track of the numbers so that you can agree upon the numbers. But before you get started, you need my review that you've gotten the right financial statements. Okay. So let's just make this bigger. And there's step-by-step instructions here on how to do that. Okay. But what I wanted to show you is at the end is the samples. So real oddly on 10K reports, the income statement shows 3 columns, 3 years, and you always want to use the most recent years. So if 2023 is available, you want to use that 10K. And if it is available, you would have 2021, 2022, and 2023. Okay, so I don't know if you guys can see this from here, but you'd have 23, 22, 21. So you would go, so in this case, this is the Cabela's company. And you can see we've got 3 years of data. Now be aware that company's fiscal year often is on the same day of the week. So maybe a Saturday. So here, because in retail, that's pretty common. And so here, the fiscal year ended December 31st, 2016. Here it ended January 2nd, 2016. And here it ended December 27th, 2014. And those are odd dates, right? Because you've got 2 with 2016 and 1 with 2014. But let's go back to the oldest. 2014 would be for January 1st to December 27th, let's say. Okay. The following year, that Saturday fell on January 2nd. So they're taking, this is essentially the 2015 year. And then this is the 2016 year. So your assignment is to get, let's go back up here. Where did I put it? Sorry for all the scrolling. Your assignment is to get the income statement for 3 years. So that's going to be one document. Okay, I mean, 1 page. Then the balance sheet, unfortunately, they only list 2 years. So you will get, let's say that the 2023 data is available. So you would get 1 balance sheet from the current 10K. And then you'd have to go back into the SEC and get the previous year's 10K and get 22, 21. And then you go back into the SEC and get 2 years back 10K and get 21, 20. Okay. Because what we need is we need 2020, 2021, 2022, and 2023. Okay. Now, you might say, well, can't I get one of these but not the other? And the answer is, can't I just get this first one and then 2 years back? And the answer is no, because it's very possible that 2021 would have been revised in the more recent year. So you're going to be using only this year, this year, this year, and this year. Okay. So we're not going to use this, even though it's on that same report. We're just going to use the most current data for each year. Okay. So Ariana, you're going to end up with 4 documents, 1 income statement and 3 balance sheets. Okay. You do not need to try and compile the data or reorganize the data. Just upload 4 pages with that information in it. Okay. So current 10K's income statement, current 10K's balance sheet, previous 10K's balance sheet, and 2 years back 10K's balance sheet. Okay. And then here's the example for Cabela's, 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 and Cabela's. Okay. Does that help?
Yes, that does help a lot. Thank you.
You bet. Yeah. So, I mean, sometimes students think they need to do a lot of, fixing on the 10K balance sheets. You don't need to worry about that. I know where you're getting the data. As long as you have the right data, then you can move forward with running the spreadsheets and calculating the growth rates and all of that, and you'll be good to go. Okay. All right. Okay. Nicholas, do you have a specific question, or are you just here for a review?
I'm just here for a review.
Okay, awesome. All right, so let's get it out. And I apologize for being late today, making you guys wait. I had we're just scrambling for alumni night, so it's all coming together, but it's
Thank you for answering my questions, Professor, but I actually have to leave early.
yeah, no, I understand. All right, you take care.
Thank
you. Okay, so let's look at, can you see my agenda? Let's make sure you can. Can you see my agenda here?
I can, yeah.
Okay. So our exam is next week, not this week. So you're really kind of focusing on wrapping up project 1 with your critiques, and you're working on your contracts for project 2. Project 2 is not as extensive as project 1. It's just running some numbers and making sure you understand all the statements and understand ratios and can calculate growth rates. Okay. So this chapter chapter 5 in summary is has a lot of journal entries, has about 14 journal entries. Chapter 4 has 11 journal entries. So you guys have a lot here. And so if you haven't gotten comfortable with journal entries, that's not unusual, but in the next week, you need to get more comfortable with the journal entries. So, take all the journal entries in chapter 4 and 5, maybe make a flashcard or some way for you to just drill on the journal entries. I want you to be really comfortable with, if you increase an expense account, you debit it. If you increase cash, you debit it, all of those things. So these we've already talked about. And then these journal entries. And then as far as statements go, you need to understand how to calculate a multi-step income statement, because we use it all the time, and you're going to see it in your projects. You're going to see it in the statements that you work with. And then you also need to be able to calculate cost of goods sold for using the periodic system. Okay. And then you're going to write a little essay on trend analysis, just like you did last time. And then when you get the practice exam, you're going to see that as well. Okay. So your job is to really understand, I write this here, and let me switch over to another spreadsheet, because I was talking to Yelena yesterday on this. Okay. All right. So as we're doing transactions, there's now going to be, of course, inventory. This was a homework question, but the logic still holds. I want you to think in terms of the company. The company is the one you're doing the accounting for. So you have to think point of view company. In your homework problems and on the test and in your quizzes, it'll say they sold to a customer. And mostly they're not selling for cash. Mostly they're selling on credit, and they're going to, the customer's going to pay them in about 30 days. So I want you guys to do something for me. In the chat, I want you to tell me, how do you know whether the company, in this case, the company name is Borst. How do you know if the company is going to give the customer a discount if they pay in 10 days or pay in 15 days, how do you know in your homework problems? You go ahead and put it in the chat. So just take a minute and tell me how you. Vanessa, you are right. So the problem has to say something like they sold, in this case, the company Borst sold to Maclina on credit. Or they could just say they sold to Maclina with terms 210 net 30. And that's how we say it, with terms 210 net 30. And that's such a confusing term because when you hear the words net 30, it sounds like they pay 2% in 10 days and 98% on the 30th day, but it doesn't mean that. It's an or. You either pay it all now, but you only have to pay 98%. You pay it all in 10 days, but you only have to pay 98%, or you can pay 100% in 30 days. So we're going to reward you for paying early, okay? Now, Borst might buy. Ooh, I haven't seen a 10%, but if they did, if they gave a 10% discount, it would be 1010 net 30, something like that, or 105 net 30. I mean, companies can do whatever they want, but I've never seen a 10% cash discount. All right, so this is, let's just be clear. This is a selling, right? Over here, this is a buying transaction. So Borst is buying from a supplier, okay? And it seems funny to keep emphasizing that, but it's really important. It gets really confusing really easy. Which one's the customer? Which one's the vendor? I don't remember. So I tend, when I'm talking to students about a problem and you're trying to figure out debits and credits, I would step back and I say, who's the company? The company is Borst. Who's the customer? That means accounts receivable. Who's the supplier vendor? That means accounts payable. And it really helps me kind of keep focused. All right. So let's review the transactions for chapter 5. Let's see if we can find the chapter 5. So there's a really wonderful summary in the back of your textbook, and I have it in the PowerPoints as well. So, but let's show them in the PowerPoints. So, can you see my PowerPoints? Can you guys see my PowerPoint slides? Yes, okay. All right, thanks. All right. So Jennifer is buying from Judah. Okay. So we are doing Jennifer's books. So Jennifer is the company in the middle, and they're buying from a supplier. Okay. That means what? Accounts payable. So we buy, it costs $1,400, the buying, and you don't have to put the word merchandise, but just be consistent. You can say merchandise inventory or just inventory, but don't use both. Use one or the other. Debit merchandise inventory, credit accounts payable. Okay. And then we have to talk about who pays the freight. So if the terms are FOB shipping point, the buyer pays the freight because the title transfers at the shipping point. So that's another transaction that the buyer has to book, the company has to book. If it's FOB destination, the buyer doesn't book the freight, the seller is going to book the freight. So right now, we are doing the buyer's books. So buyer is the company, okay? So here we go. Who pays the freight? The term's FOB shipping point. That means the buyer has to pay the freight. So that's another transaction. So here's the freight bill. It's $140. Again, that goes to inventory. That is one of the charges for inventory. So the inventory didn't just cost $1,400, it cost $1,400 plus $140. Debit merchandise inventory, credit cash. If the seller had had to pay the freight, if the payment terms, sorry, if the shipping terms were FOB destination, then the seller would book this entry. But it's one or the other, it's not both. Okay. And this entry is not made by the buyer. So we're not gonna book it. I'm just showing you this. All right. So now we have the buyer has received the goods and then they're trying to decide if all the goods, all the inventory is okay, if it's not damaged or anything. If it's damaged or something's wrong with it, wrong color, whatever, they're gonna return it. So we're gonna say, in this case, the company returned 2 calculators. So we just reverse that journal entry. We debit accounts payable and credit merchandise inventory. Okay, it's real simple. So when you buy, you increase inventory, increase accounts payable. And if you return, you just reverse that journal entry. Okay. And then here's all the different discount terms. All right, so remember that, let's go back to the invoice. Oop. The terms are 210 net 30. And the date is February 4th. So they're going to pay this bill on February 14th. And the problem won't tell you, hey, remember, they're eligible for a discount. You have to figure it out based on the dates. So if the date of the invoice is February 4th and the payment date is February 14th, and the payment terms are 210 net 30, they're going to take the discount and you need to build it into your journal entry. So first you have to decide what do they owe at this point. They don't owe 1,400 because they returned 130. They only owe 1,270. So you can only take the 2% discount on the 1,270. And so here we go. We're reducing accounts payable. We're clearing it out because we don't. So the balance is here. Now we're going to debit it. We had a credit balance. Now we're going to debit it. Cash is at 98% of 1,270. And we're going to credit merchandise inventory for that 2%. And please don't put pennies in your journal entry, just round. If it's 50 cents or more, round up. If it's less than 50 cents, round down. Okay. If they didn't take the discount, if they paid a month later, you would need to know that by looking at the dates. And then you wouldn't have that 2% discount. You just debit accounts payable and credit cash. Okay. So the question is, how much did the inventory cost? Well, the basic purchase price plus the freight in, less the return, less the discount. So those calculators cost $1,385, $1,385. Okay. So would you guys like to do a practice problem or do you have any questions at this point?
I don't, actually, about the 210 net 30, is it talking about like you get 2% off if you pay it off in 10 days,
Exactly.
and you get like nothing if you pay it off within like 30, right?
Right. And the normal payment terms are 30 days in the United States.
Okay.
Okay.
So,
I will tell you, Nicholas, that
mhm,
if you sell to Walmart, sometimes they don't pay for 90 days. So just
okay.
but that's because they're big and they're kind of
Okay, so and it's not like it's not like a set rule that like they have to follow. It's like the company chooses what it is, right?
yeah. And
Okay.
people, it's like Costco pays in 45 days. And it's like, well, do you
Hmm.
want to sell to Costco? If you don't, you don't have to sell to Costco. But if
Yeah.
people do want to sell because they're such a big store, you know. So let's do review. Let's just take a practice problem. Let's see if we got one. Let's do number 4. Can you guys see it there?
Yes.
The company makes a credit sale, it grants a return. what amount is received as payment? So this is a sale, it's not a purchase, but we're still using that 2%. Let's see if you can figure that out. And if direct message me in the chat, so I'll give you a minute to work on that. Yeah, we'll do that too, Vanessa, but give me the answer to number 4. What's the amount that they will be paid? So this is you guys having to work on dates and everything. I have that. What's the answer to number 4? Okay. Nick, do you know the answer? Nick, you are correct. You're slightly off on the rounding. Oh, no. Let's see. The textbook says the answer is 686, but
Yeah, I accidentally made a mistake. I forgot to
it's
I took the 2% out of the 750 rather than subtracting 50 from it.
right. Okay. So it's $700, right? It's net of $700, and you're just going to take that times 98% and get 686. Actually, I thought maybe you rounded. That's what I was thinking. Okay. And then let's see. Looking at the gross profit here. One profit margin. Okay. All right. So let's see if we can do some journal entries. Let's see. Do you want to do a practice journal entry, or do you want to keep going?
I mean, I would like to keep going, but
Okay.
it's whatever, because I'm on a little bit of a time crunch,
No
so
worries. Let's do the sales. Do you want to go over the perpetual sales?
yeah, sure.
Okay. So again, now, and this is another tricky part of chapter 5. We have been doing, let me write this up in the, okay. So in this example, Jennifer was buying from Judith. Now we're going to say, and we did Jennifer's books, the buying transactions, which means we were doing accounts payable. But now we're looking at from the point of view of Judith. And so Judith is selling to Jennifer, which means on Judith's books, it's going to be accounts receivable. Okay. All right. All right. So $1,400. So in these problems, you absolutely have to they have to tell you what something costs. You can't make it up. So you know what it was sold for because we had a copy of the invoice. So just like in chapter 3, if you sell something, you debit accounts receivable. And instead of crediting service revenue, we credit sales because there's inventory involved. Okay, so be sure to use sales here. Now for perpetual, you perpetually track the inventory flow. So we want to show that inventory is going down. And they have to tell you what the cost of that inventory is. It's not $1,400 because we buy at one price and we sell at a higher price. That's how we make money. And that's how we pay the other bills that besides the inventory. Okay. So you can be given the dollar amount or you can be told calculate it. So in this example, I did both. I said assume cost of goods sold is 75% of sales. So you could take the 1,400 times 75% and get the cost. Sometimes the problems will say even requiring a little more calculation. They might say the gross margin percent is 25%. Okay. Now remember, gross margin is the difference between net sales and cost of goods sold. So if you know gross margin is 25%, you can calculate cost of goods sold. Sales is 100%, gross margin is 25%. Therefore, cost of goods sold is 75%. So just be mindful and read the problem and see if it's telling you cost of goods sold. If they give you a dollar amount, if they give you cost of goods sold in percentage, you apply it. If they give you gross margin, you take 100% minus gross margin and then apply it. So we have inventory on the balance sheet. It's an asset, and now we're moving it out to sell it. And so we reduce inventory with a credit and we debit an expense account, but it's a particular expense account, cost of goods sold, which is only the cost of inventory that we sell. Because we don't have it in our books anymore. Now we've got to show that we sold it. Okay. So we're doing the same transactions, but we're doing them from the point of view of the seller. All right. So sales returns and allowances. Again, same amount here, $130. And then we put the number back in inventory and reduce cost of goods sold. So those two accounts are just flipped. For the sales value, we credit accounts receivable. The customer no longer owes us this money. And instead of debiting sales, we debit sales returns and allowances. How did we get the 98? We used that same cost of goods sold rate, 75%, and applied it to 130. And finally, the customer pays us. And note that these dollar amounts are exactly the same as when we did the buying transactions. But we're doing it from the point of view of the seller. So we instead of spending the cash, we collected the cash. We got rid of accounts receivable, $1,270. And we booked that 2% discount to a new account sales discount. Okay. All right. Let's look at the multi-step because see if I have it here. Okay, Vanessa, you asked a good question. You said, why does interest expense not count as an operating expense? So let's look at operating income. We've got first, this is the multi-step income statement. So first we show everywhere you see this pink is a calculation. When it's not pink, it's an actual T account balance. So the ending balance as of February 28th for sales was $250,000. Ending balance for sales return and sales discount was 8 and 5 respectively. Remember those lower sales, so we subtract it. And then we calculate net sales. With the perpetual inventory system, we're always tracking cost of goods sold. We know what it is. So we just lift it from the T account. And then remember on the multi-step what you subtract. Don't add things that you're supposed to subtract. So we say, here was our net sales, here was our cost, and this is our gross margin, also called gross profit. So that's up to here. Now, the operating expenses are the normal expenses that it takes to sell product in this case. Okay. So things like salaries, things like utilities. So let's take an example of Nordstrom. The salaries of the people who work in the Nordstrom store, work in the Nordstrom distribution center, work in corporate headquarters for the purpose of selling, which is mostly what Nordstrom does. utility expenses for the stores, for the warehouses, etc. Advertising, depreciation on equipment used in the stores, the factory, the distribution center, and corporate headquarters, freight out, and insurance. Those are all regular and normal costs of getting the product out the door. You have to buy the product, you have to warehouse the product, you have to display it in a store, and all the costs that it takes to do that. All right. Add up all the operating expenses and subtract them from gross margin. But then we come to other income and expenses. Okay. These are additional activities that the company does. They could be miscellaneous revenue, could be miscellaneous expense, but they're not part of their normal business. Okay. So the example I give is operating income is telling you how well Starbucks does at selling coffee and coffee products and merchandise. How well does Amazon do in selling products? How well does PACCAR, Kenworth, Peterbilt trucks do at selling trucks? This other stuff is outside of those activities. So examples are interest expense or interest revenue. Anything that says gain or loss, they're going to go down below. So there are things that are outside the normal operation. So interest revenue, interest expense, that's part of financing. So remember, companies do three things. They do operations, they do investing, and they do financing. So the operating expenses only have to do with running the core business. Okay. Does that help, Vanessa? Oh, good. Okay. So know how to calculate that multi-step. And so here we have the whole thing. Now be careful when you get to other revenue and other expenses. We're going to add other revenue and we're going to subtract other expenses. And over here, it comes over as 700. And when you do one of these, you've got to ask yourself, was it net revenue or was it net expense? In this case, it was net revenue. So we're going to add it to income from operations to get 207,978. And then assume a 20% tax rate, calculate income tax expense, and then we come down to net income. So Vanessa is asking, a service company would not have a sales section. They would have a sales section, but they would call it service revenue. So it'd just be a different title here. And of course, they wouldn't have returns, right? Because they're not selling a tangible product that they would return, but they could very well have service revenue discounts. Okay. And we're not going to do a single step. Okay, finally, let's see, how's my time doing? I've got about 10 more minutes. Periodic inventory system. Something you need to know is we do not track inventory and we do not track cost of goods sold at the point of sale. We calculate it once a year or once a month. So you only make one entry for sales and you only make one entry for returns. And that's the big difference. So let's look at it on the sales side. So here, if this were periodic, you'd only book the first two lines. You wouldn't track on cost of goods sold and inventory. Here's that return. You're only tracking the first two lines. They're the same for both methods, but you're not, in periodic, you're not tracking inventory and cost of goods sold at the point of sale. You calculate it later. And then this is exactly the same. No, let's go look at this. So Vanessa, can you clarify about freight in? Yeah, we did already do it, but we can review it. Are you just looking for a journal entry or are you looking for the? When would it be used? Okay, let's just back up and just give a quick review of that. No one's a little tight on time. All right. So how do you know who pays the freight? You look at the freight, the shipping terms. And it is FOB shipping point. The other term would be FOB destination. And the FOB stands for free on board. It's an old shipping term. Okay. So FOB shipping point means title, ownership. Title is another word for ownership. Ownership transfers once the seller puts it on the delivery truck. And it can't be a delivery truck that the seller owns. It's got to be like a freight company. Okay. So that means if it's FOB shipping point, it means the buyer pays the freight. If it's FOB destination, it means ownership doesn't transfer till it arrives at the destination. The seller pays the freight. Okay. So here's when the buyer pays the freight using a perpetual inventory system. Debit inventory, credit cash. If, however, the seller paid the freight, and they didn't in my example, but if the terms were FOB destination, the seller would book this entry and it would be called freight out, not freight in because it's being shipped out and it's an operating expense. Okay. Now, so for a perpetual system, let's be clear. For a perpetual system, everything is booked to the inventory account. The original purchase, the freight in, credit for returns, credit for discounts. There is no freight in used for perpetual inventory system. Now let's switch to periodic. Now, we talked about the sales transactions already, but now let's look at purchases. So we use separate 4 new accounts in periodic because we want to know what they are. They're purchases, purchase returns and allowances, purchase discounts, and freight in. So inventory plus purchases, less purchase returns, less purchase discounts, add your freight in, count your inventory, subtract it, and you end up with cost of goods sold. But let's go over the journal entries first. All right. Periodic inventory, you buy. We're not using the inventory account. We don't use the inventory except once a year when we count the inventory. So we debit purchases and credit accounts payable. That part's the same. Here is we only use freight in with a periodic inventory system. So here's where we charge the freight in and cash. Here's the return, debit accounts payable, credit purchase returns and allowances. And finally, when we pay, debit accounts payable, credit cash, and credit purchase discounts. Okay. But I want to show you a side-by-side comparison. And this is also in your textbook, and it's super helpful. And if you guys have access to a printer, I would strongly encourage you to look at this. So let's go to the textbook, chapter 5, and let's go to periodic. And you can see at the back, I've marked mine up, so apologies there. But here you have purchases at the top. Here's perpetual, here's periodic. Sales transactions, so here's the purchases, purchase, freight, purchase returns, payment. And then here you have sale, return, and cash, perpetual system and periodic system. All right, so here I've just put it again on my PowerPoints. So here's the sale, the purchasing transaction, and here's the for perpetual, and here's the purchasing transaction for periodic. Here's the sales transactions for perpetual, and here's the sales transactions for periodic. Okay. So these are kind of quick little cheat sheets that you can use as you're learning this. So there's a lot of similarities, but let's go back to purchases. You have 1, 2, 3, 4 new accounts here on the periodic side, but on the perpetual side, you only have inventory. So perpetual is a lot easier, okay? And then I have some practice where you can do a perpetual multi-step income statement. And then I say calculate cost of goods sold for periodic. And this is the format for it. And then there's some solutions here, okay? All right, I think our time is up. Do you guys have any last minute questions?
I'm okay.
It's a lot, and no, it's a
Um,
lot of journal entries, and that's why we're giving you guys, I'm giving you an extra week on this one. Just because it was a lot, but we want to make sure you understand. But a lot of it has to do with just being able to drill on those journal entries, okay? All right. I will see you guys later. Please come to Alumni Night, Vanessa, if you can, and but I know you're on crutches, so do your best. So it's just a great opportunity. I'm gonna send out a list of the companies that are gonna be here and the jobs that people have in those companies. So should be really fun. All right, I'll see you guys later.
all right, thank you. Bye bye.
Bye.
Thank you.
Bye bye.